Hey Shane, how's it going?
It is going, getting a little bounce in the S&P 500 and the Nasdaq index here so far today. Probably just a little FOMO bounce, some shorts covering, not a whole bunch of people excited to sell down here at the lows. So little relief rally on after yesterday's carnage.
Absolutely. And yet today, so it's May 19th and it's 10:14 Mountain Time. So I agree. Yesterday we had that huge sell-off, and after a day like that, you're going to see a little bit of a bounce. We'll see where it goes from there, but I have SPY pulled up here, and we referenced this level last time, but it's kind of that 410 level. As long as we're below there, definitely looking bearish, but we will see bounces in here, and that's what gets frustrating. But for me, I love this level down here, 353. I think I'd like to put a little to work down there. In the meantime, I think we're going to see some bounces, and what I kind of look at here, I'll just pull it up, is you can go off the prior candle low. So this candle we put in here, if you draw a line off that, that's kind of the near term resistance I might be looking at, but we've got a very big level right above it that we've drawn before that, this kind of 412 level, that's going to take a lot of steam to get back up through that.
Why do you draw that line you just drew at 40302? What's the
Mhm.
what's the logic behind the low end of the wick on the high print? Like, is that just, that's a normal level? I never really looked at that type of a level before.
Yeah. So the way I like to trade a lot when I'm looking at the candles is on a short like this, I look at the prior candle low. So where it prints right here, that is my risk level. So if I
But that's
was
not the prior candle, right? Like the prior candle, yesterday's candle is that giant red one.
right, but for how I look at, so I look at the candle before the day close. So I look at a kind of a 3 candle setup. So right here, you've got today's active candle. So it's still printing.
Mm-hmm.
You've got the intermediate candle, and then this is the one I like to risk off. So
tomorrow you'll move that to the low end of the big red candle?
essentially how I'd be looking at it is, at the bottom of this candle, that'd be my stop. So if I got hit there, I'd be out on a short-term trade, and I'd be looking for an entry like on a day like today, up kind of in this region. So you're looking for a short right around 399, and then the risk or the stop is going to be right at that 403 level. So just something I've kind of learned over time. Just a nice way to manage risk on trades like that when trading the candles. So
Interesting.
to each their own, but that's a level or kind of way I like to look at it.
But you're not in anything short the SPY right now?
Not right now, no.
Hmm.
Yeah, because right down here, it's one of those, we needed that bounce, and after a big red day like that, I think it could work up into that area. And like I said, breaking through that turns a little more bullish, but on a day like today, you'd be shorting it down here near the bottom. And just from a risk reward standpoint, the odds are not in your favor.
Yeah, but and that's what, like, that's like 5% higher or 4% higher than where we are right now, right? Because yesterday was like
Yeah.
a 4% down day.
Yeah. So that was a pretty big move. If you just look on the hourly from yesterday, we've got pretty good ways to go to get back up into kind of where yesterday started. So it opened up there, gap down, and then sold off all day. So yeah, I think it'd be totally reasonable to see price come back up into this kind of 398 level.
Yeah,
And
SPY was down 4% yesterday, and right now just trading barely above where it closed at the lows. So I don't know. Yeah, I like shorting things at their lows. I don't know about you, but Jesse Livermore, the greatest trader of all time, says sell things when they're at their lows and buy things when they're at their highs. That's how you make money trading in my world. So yeah, I'm if it bounces up to that level, I'm not looking to sell it there. I'd be looking to sell if it put in a new low today. That means it's going lower. That's where I would sell it. But I'm not short the SPY right now either. I'm really not short Qs either at this point. I shorted some Facebook yesterday, and I'm still short good RX. And I'm still long wheat. So anyway, we'll see what happens, but mostly cash. Cash is king.
yeah, managing the risk. And I think too, if we want to go ahead and, we can look at the Nasdaq quick. Same thing. So we drew these levels last time. We're just consolidating around this level here at kind of 293. And I think both you and I agreed you got this support down here, which is another 12% lower. And then kind of the really nice level I like is down here, if you could pick that up. But this is where I think
that's the pre-COVID high, right? That
it is.
was that 235. And I think erasing every penny that was made in the markets after COVID is probably logical and fundamentally sound, because there's no fundamental economic reason for us to be higher than where we were pre-COVID. The economy's done nothing but get worse since COVID, and the fact that the market's up over that time frame is based on nothing but government intervention. And now we know the government is no longer intervening. Powell was out day before yesterday, which is why the market finally got hit so hard yesterday. Was because the day before, when the market hit its short-term high here, if you zoom in to that 3 days ago candle, the reason it went higher was because people started covering shorts like crazy while Powell was talking, even though everything Powell said in his press conference, or I guess his interview, was terribly bearish. And then finally caught up with the market yesterday, and it dropped hard. But basically what he said is that don't look for us to come and print money or ease monetary policy, or in other ways save the market. We are going to tighten until inflation breaks. And that, inflation means falling prices. It means falling prices in gasoline. It means falling prices in milk. It means falling prices in stocks. It means falling prices in bonds. Everything across the board, which is why the market was up, because them easing meant higher prices across the board, including for stocks. So at this point, there's still nothing to be bullish about. There will be short-term oversold bounces. There will be short covering rallies, where the only people in the market that are buying to close short positions. I don't think there's going to be a flood of people opening new long positions at these levels. And if they do, they're probably going to get hurt. So that's what we got going on now. And I think again, if you zoom back out, going back down from here to those the pre-COVID highs, it makes great logical sense to get down to that 240, 235 level on the Qs.
Absolutely.
It's like one. What's the level on SPY? That's the pre-COVID. Can you flip back to SPY and?
Yep. So SPY is right here at
330. Yeah, 339.
339.
Okay. Yeah. So a ways lower on each, if we're going to ultimately go back to those levels. But I mean, with the Fed telling you what their plan is, assuming they have any credibility and that they actually stick to it, we're probably going to be in this type of an environment until the end of the year. I don't really see any good reason for it to change before then, unless prices just absolutely fall off a cliff across the entire economy, before the end of the year. I think a slower grind lower for the rest of the year is probably more of a logical expectation. So we'll see what happens. I could be wrong, and I often am. So I'm not stuck to that, but that's my current thinking.
Yeah. And that's same for me. Summertime usually is pretty volatile. And if anything moves down or sideways, I'm not expecting a big rally, but yeah, it is. If you had money up here, odds are you probably still have some in here, and that's good. So if you've got cash on the side, but you stay invested and it bounces, you still have ample time to get back in, and all is well. But being 100% invested right now is a little scary, knowing that not really any main support until we get down into this level. So
yeah, I would not want to be fully long right now. No, thank you.
Yeah. So the next thing we were looking at, so oil, it's kind of the same update every week on this one. So it's continuing to just consolidate right here. It's still working higher, so you're getting lower or higher lows through here. And I think it's going to take a little time. I don't know what the target is. I know there's some analysts out there saying 200, some pretty big numbers coming out, but main thing here is simply it's continuing to work higher. And if you wanted to risk off some levels on this trade and still get in, anything pulling back to these lows looks pretty good.
Yeah, as long as it holds above the 50-day there, I think is even better. So yeah, I'd still rather be long crude than gold, although gold finally maybe put in a bottom.
Yeah.
Well,
And
for this move anyway. I don't know. It's trading below the, well, oh wow, look at that. It's
yeah.
back above the 200-day moving average here today. So that's good. Nice little pop in gold. And interesting. Yeah, if I were looking to be a long-term holder of gold, I would definitely be nibbling at these levels. Um, yeah, that's nice.
Yeah, I like that one. I think what I'm looking at here is I want to see this candle actually close today and
Yep,
stay above this average.
yep,
And then tomorrow look for just a little bit of a pullback, or if you're in the futures market, you can get in overnight. But a
yep.
little nibbling there long, the risk reward there is looking pretty good. So that is, let's go ahead and just measure that for reference. But if you got in there, I'd say you'd want your stop down here. So you're risking about 1%. But your next target from there would say easily, this high that was put in on that candle, that is 4% higher. But if you took it all the way back up to the highs, you're 8%. So gotta love trades like that. That's what 7 to 1 about. So
Yeah, I would use the low close price on May 13th of what's that? 1808 was the close on May 13th. That's what I would use as my stop.
okay. Yeah. So, still pretty nice little trade there. So 2% maybe
Yep, risk
on the
2%.
downside.
Yep.
I'll take a trade like that. Now let's look at treasuries. So still just kind of backing and filling here. I think rates still trend is up. I don't know if you had anything to say on that one, but I think it's probably just going to be a little chop for a bit and then see where it goes.
Well, I mean, if you suddenly can get 3% by buying a 10-year bond from the US government and all you're looking for is 3% to live happily ever after, I think you find buyers there up at 3%. So that makes sense. People want to buy the bond when it gets up to that 3.15 level, and now it trades back a little bit below 3%. The buyers will step away, and probably some room for that to consolidate as the 50-day moving average, the red line there, catches up, and probably takes a leg higher after some consolidation. So I mean, if you drew a line connecting the the recent few lows from, I guess, early April until now, it's pretty much still holding that level. So that's early March. That doesn't work. Nah.
I guess
Yeah, right there. Yeah. Nope, not there.
hold on a second. Just grab my drawer there.
Nope, not that one either. The next one. Yep. Nope.
Go ahead and remove that one. It's funny, technical analysis, everybody draws their lines a little different.
Yeah, that recent low right
So
there.
right
I mean,
there.
if you connect that low to, there you go. That's the level. I mean, so it's breaking down below that right now. So I wouldn't be buying interest rates, you could buy bonds. Bonds were up yesterday while the market was down 4%. TLT was up, HEG was up. So people want to buy these bonds. I mean, when you're getting killed in the stock market, you can get, 3%, close to 3% on a bond. Haven't seen rates like that in a long time. So that's going to attract some buyers. It's going to attract international buyers too. Because if what's really funny is I was looking the other day. I don't have anything prepared to show, but the United States 5-year bond is the second highest yield in the entire world. I think behind Australia.
Mm-hmm.
So we're like the high yield bond or junk bond market for the rest of the world. So if you're like, if you're in Europe or Japan or any of those places and you're getting like close to zero, less than 1% yields on your bonds, you got to look at like, well, I could just put some dollars in the United States bond and get 3%. That's a really good return for anybody, outside of the United States. I mean, it's a good return for a lot of people in the United States compared to stocks going down 20%. So
Yeah.
that's going to attract some buyers, and that'll put a limit on rates in the near term. But I think it probably will consolidate above that 50-day moving average, and then rates will make them move higher. If you go to the mortgage rate, check out the mortgage rates right now. They have not pulled back.
Yeah. And I'll jump over there in a second. I was just going to point one thing out. Notice how, the averages are so close right here as it was consolidating, and then you get this large move. But now you look and there's such a large spread in the averages. So it's just natural. It's going to consolidate before it makes any big moves.
Yeah, let the 200 catch up to the 50. Take some time. It's a big move. It's a big move.
So here's mortgage rates.
Yikes.
Not liking that one.
Yeah, 5.3 and climbing. So um, some folks from my church just listed their home. It's the exact same model as my home. They listed it last week. And they have gotten no offers yet, which is very strange compared to what's been happening over the past, year or so. They listed their house 17% higher. Is that right? Yeah, 17% higher than what I paid for mine in September of 2021. So not even a year later, and they listed for 17% more than what I paid for mine, and I overpaid for mine by a lot. I'm convinced that I will be underwater on my home at some point in the next few years. I just don't have any doubt about it. I know I overpaid. But I had a wife that was like, get me into a house because we were living with my mom for a while and it was time to move on. So we were willing to pay a bit more to get into a nice home. And we did that. We can afford the mortgage. So I'm not too worried about it being underwater for a short period. I think in the long run, it'll be worth more than what I paid for it by the time we're ready to sell. But I do find it fascinating that, that you can list a house. I mean, he got a couple realtors' opinions, and they all the realtors he talked to agreed that they should list it for what they listed it for. But at the time I was bidding on my house, I had to overbid, and I had to do it very quickly, otherwise the house would be gone 2 or 3 days later because bids were coming in faster than people could even evaluate them. And so now we're a week later, and the guy hasn't gotten any bids, any offers on the house yet at the current price. So as much as he wants to sell it for 17% more than what I bought mine for back in September, with interest rates going higher, it just cuts into how many people can actually afford that home, and how many people can afford the mortgage payment on that home. And I don't know what the banks are doing. I don't know if they've tightened yet, looking at credit quality, but they should be, because delinquency rates are climbing across the board. And with milk and gas and many other things being as expensive as they are, people are unable to afford such high mortgage payments, and they're even having a hard time affording their Netflix subscriptions. Netflix keeps raising their prices too.
Yeah.
And people keep canceling. So this is supply and demand in the housing market is the only reason that prices are still as high as they are, because without that imbalance, right? Not enough supply and too much demand, housing prices would be crashing right now, like literally crashing.
Yeah.
So it's a good thing they're not. But
when you look at this, we drew this as a target a while back, and it's not going to go there overnight. It's going to take some time, but in between this high and here, there's really no other resistance. I guess, you could look at this level here as a next stopping point.
Could you remove the 50 and 200 so that we can focus on what the actual is?
Yeah, absolutely.
I don't really like the moving average on a chart like this. There you go. Yeah, that's a little cleaner. Okay. Yeah, so I mean, it'll probably try and hang out around those other peaks, right, as we get to them. But the major level I still think is up there near that 6.8.
Mm-hmm. So, well, I've got 3 other areas to hit on here. So let's do Bitcoin and then Tesla and Apple, and I'll just let you take over because I know you got your wheat trade we'd like to do an update on, and then maybe we can talk about some GME and AMC.
Yeah, there's some goofy things happening out there.
Get my averages back on here. So right now, Apple, this is one I'm really watching, and I think you are too, this has been a strong stock for some time and for all the right reasons. But right now, this line we drew, this was based off the high of September 20, or 1st of September in 2020. It's been holding and we're sitting on there. So it's right at 138. If we close below this level, it starts making me nervous. I think we're looking then to come down here to 110, which is the top of this run up that we had. And then it kind of bounced around there. So let's draw that in. But if it can't hold at 138, I think not only does it kind of take the rest of the market with it, but I think it's certainly gonna probably move down to that 110 level. What are your thoughts?
Everybody in the world is watching that 138 level. Everybody in the world. Zoom in a bit. Zoom in a bit. Because over the past like 5 days, we've tagged it, like I don't know, what can you hover over that first time we tagged yeah, that one. So on May 12th, perfectly tagged that number. And then rallied back, bounced a bit, and now right now today, right, we dropped a little bit below that 138 level for a while this morning, and Apple has so far recovered. So there are a bunch of people, bunch of traders, bunch of portfolio managers, all of the above. And as you guys could tell from watching this video, sometimes people try to buy the low end of the range, for a run. I don't ever do that. Like I would never buy Apple here for a trade because it's at the low end of the range and it might bounce from here. That's just not how I trade. I'm looking for that sucker to break through 138 and short it if it closes below there, because if it breaks and closes below this level, it's going lower, almost guaranteed. No guarantees in trading, obviously. You can't be for sure. But if it closes below this 138 level, and I just have it drawn exactly at 138, if it closes below there, you short it and you use 138 as your stop. Like it's a simple risk reward trade. You're not risking very much. If it closes back above 138, you're out of the trade. But if it drops to 110, you're going to make like 30%.
Mhm.
It's such an obvious trade to me. So I don't have any desire to sit here and try and pick this bottom. Again, it's the same on this side though. If you're trying to pick the bottom here, which again is a smelly business. I don't pick bottoms. But if you bought it here and you use a close below 138 as your stop, you're not risking that much to see if it bounces here. So I understand why people do that, but I just don't see a lot of people buying in this market. I don't see a lot of people opening new longs in this overall market
Mhm.
environment. And so I would not do that trade right here. You might get a short-term rally, but I just think the trend is down. The 50-day moving average is approaching the 200-day moving average from above. When those two moving averages cross, there's going to be a whole bunch more traders that get an alert to sell Apple, either short or take profits. And this is where a lot of hedge funds have hidden out. Like there's a lot of institutional money that's just hiding in Apple right now. And it held up really well during, the majority of this year's drawdown compared to the rest of the market. But when Apple finally started getting hit and sold, which I could flip to my chart if you want, but we talked about it last time, like I guess that low from March when it first dipped below the 200-day moving average. If you hover over that, nope,
Mhm.
yep, that one right there. If
Right
you
there.
draw a line at that low. So
And
we said on the, I don't think it was on the last call, like if it drops below there, it's going lower because that's what happens, right? And so it's I don't know. I think it's dead money. I wouldn't want to be long or opening a new long position in this. I'd be looking to trim some. If it closes below the 138 level, we're going to trim some more for our clients, and I might look to short it personally. But it's not because Apple's a bad company. It's because the market is in a really bad spot and it's not getting out of that spot anytime soon, as we found out from the Federal Reserve chair just the other day. So there's just nothing to be bullish about here. Picking bottoms is, I don't know, in quad four where GDP and CPI are both decelerating and the Fed's tightening into it. The odds are not in your favor, no matter how pretty the chart looks. The odds are on the side of the shorts right now. And someday that'll change. But for right now, that's the situation we're in. And, should act accordingly. Cash is king.
yeah, and I wanted to point out a couple things. So look at that, how it hits that level. And then here, like we talked about, it breaks through. And as often happens, it came back for a retest of that level.
Yep.
So if you want to talk about a short and what this looks like going forward, longer term could still go up and work its way higher. It'll probably take time, but what I'm looking at here is check this out. So this candle that we had on May 12th, look at the volume. So
Yeah.
you have this huge volume spike, comes down, hits that level, bounces up. So that level means something. There was a lot of transactions that happen right here. I think what you would likely see is it comes up, works its way through, and much like it happened right here, you would see or hope for, I guess, a retest to that level, and that would be just a glorious short entry.
Yep.
So that's
Sure
where you
would.
can risk off 138. and take it lower to maybe 110.
Which is why if I shorted it on the initial break below, I would use that as my stop, because if it breaks back through that level on a closing basis after dropping below it, you're probably wrong, you know, and you'll have another chance to short it again. So yeah, ideally what you just drew is exactly right. And I wouldn't get stopped out. You know, I'd be up and then I wouldn't be up as much, and then it would stop out or wouldn't stop out and go lower with me still max short.
Absolutely. So I'll do, you know, 2 more here and then turn it over. Tesla, this is the level I'm watching. Much like Apple, Tesla's one that has held up really well in the market. So if it cannot hold this level, and again, I expect a bit of a bounce and then trying to break through that level, but if that happens, then you're looking at, I think, at least coming down to this level. So kind of 545 is your next level of support.
Yeah, that's ugly. I have a few clients that own this position in their non-discretionary accounts, and I was in talking with them. We put the stop at a close below $700. So it's just 700 on the nose. If Tesla closes below $700, which it's dropped below on an intraday basis a couple times, if you zoom in over the past few days, it's dropped below that 700 level. You know, a couple of those wicks are down below, but it hasn't closed below the $700 level.
Yeah.
So if it closes below 700, that's where I would be closing it or shorting it. Again, I like to sell things when they're at their lows and going lower, buy things when they're at their highs. So there's not a lot to buy right now. Not much is at its high.
Now, and then just the last one here is Bitcoin. Just looking at this, and we already had drawn these levels, but
shocker.
I'm looking at this one right here. If it cannot hold that right around 30,000, I mean, Shane, you do Bitcoin more than I do. I don't even know where to draw the level, because what value does Bitcoin have? I don't quite know, but you know, my first guess is maybe we get to the top of that rally. That's 19,000.
Yep.
What do you think? I mean, that's just an ugly chart, but
so zoom in on that a bit. So the what do we got that green level at? You got it at 29.5. So I have my stop at like 28.5, which is the very bottom of that wick on the left in like June of 2021, like way over on the left. No, way over.
Oh,
that.
June. Yeah,
that one. That's pretty much where I have a close below that low is where I would stop out of Bitcoin. And you know, stop prices on or closing levels on Bitcoin are interesting because it trades 24 hours a day, you know, 365 days a year. So you know, they start the candles based on GMT. So you know, those are not quite as hard and fast as normal legacy market stops that we use, but that's the level I've given to people. You can see it dropped way below that, down to like, you know, 25,000 on an intraday basis. Again, if you zoom in a bit. So you know, you can see that. So I mean, it's holding right around the level that, you know, that I think it should. But if it can't rally from here, to be honest, dude, I'm not trying to buy Bitcoin until it's at like 13,800, which would be an 80% decline from its all-time high. If you've been trading Bitcoin for any length of time, you know that Bitcoin often drops 80%. It's done it several times through its history, 80%, and then recovers to go on crazy runs to new all-time highs each time so far. So I don't expect Bitcoin to go to zero. But I would not be surprised at all if it dropped 80% from highs, and that puts you around $13,800. So I think, you know, again, if you zoom back out, I think the levels you drew are correct. I think if it doesn't hold here, it will go down to that 19,000 level and, you know, try and bounce there, probably consolidate there. You'll get some buying interest there. And then if it doesn't actually rally and get back above the 50 and 200-day moving averages at that point, it will go down to like 13.8.
Yeah.
Or, you know, or more. Who knows, but that's my current thinking on it.
And then here we go for just some technical patterns, but here you got left shoulder, here's the head, right shoulder, measured move off that puts you, I mean, this is going to be just a scary number because it's from the top of the head to the neckline. You double that down, which would, I guess that'd put you probably right down in this area, you know, So yeah, like you're saying, maybe 13.5,
Yep.
somewhere in there, which would be about 80% right on the
Yep.
nose, down from the highs.
Yep. I mean, it's just natural for something that runs that fast to the upside. There's no reason that it can't drop that hard on the downside. I mean, it's just totally natural.
Yeah.
And all the people who, all the people who say they're going to buy it and hold it forever and retire, I'm like, that's when they capitulate. Like they're like, I can't take it anymore. I can't watch it go to zero, and they'll sell. And
Yeah.
that's when you'll be want to be ready to buy. So it's just how it works. It's not about making friends, it's about making money. And unfortunately, human beings in general, are really, really bad at this kind of stuff. They tell themselves one thing and they don't choose their stop levels before they get into a trade. And then when it comes time to sell and things are crashing and going down in leaps and bounds, um, they're in too emotional of a situation to do anything about it. So what they do is they turn off their screen, they take their trading app off of their phone, they stop looking at it, and they just go down with the ship. And then when they finally open it again 5 or 6 months later, they're like, oh, I can't do it, and they just sell. And that's what you call a capitulation move. That's when it's done, and everybody who wants to sell has sold, and there's nothing but buyers left. And when there's nothing but buyers left, that's what makes the price go up. So this is, technical analysis isn't magic. It's simple human behavior. This is a map of how humans behave over time, and you can identify trends and take advantage of them. So that's why we do it.
Absolutely. So, well, Shane, I know you got a couple stocks you wanted to look through, so I'll stop sharing here and let you take over.
All right, give me 1 second to load up. We'll just, I guess we'll go with the wheat chart here. Let me just get it ready. Sorry. There we go. There we go. All right. I am ready to rock and roll. Oh, I'm disabled. You got to enable me. I can't share.
There you
Sorry,
go.
y'all. You don't want to see our giant faces. You want to see charts. There we go. Here it comes. All right. So the wheat trade. Last week I told y'all that I had stopped out down here, so I lost a little bit from 11 to 1075. And then what I did is I got back into the trade. So I got back in right in here at this green arrow around 11:15, and had a nice big rally the next day. Limit up. Wheat was limit up that day, up 5% in the futures market. So that was nice to see just the day after getting back in. Had another up day, and then I gapped up. India banned exports of wheat. So that will put a strain on a global market that is already kind of trying to figure out what to do with the lack of resources coming out of Ukraine for wheat. So India banning, that's why you see things go limit up. It's no surprise. I mean, I don't know how many people knew that India was going to ban, the export of wheat on that day. I don't know who was trading on insider information, but I guarantee you some people knew. Someone out there knew. Many someones out there knew, and they were preparing for what would happen, because when a big supplier like that goes offline, the price is going to go up. You take that much supply out of the market and demand remains constant, the price is going to increase. So it's no surprise to me that following technical analysis, like the things that we were seeing in this area after the breakout, were leading to a news event. Which is why I always tell people, like, don't try and trade the news. You can't do it fast enough. People have algorithms set up to trade the news. You're not going to be able to look at a headline and then go make a trade. You see the headlines on the tape. You see them, in the trading market. You're like, oh, I don't know what's coming, but something's coming. And you might not find out for 3 or 4 days why, why did wheat break out on this day? Why? Well, because India was going to ban export on wheat a few days later. That's why. So there's no headline to look at. You just have to follow the money. You got to look at the volume on that move compared to, the recent volume. There were a lot of people taking a position long wheat on that day, and there's absolutely no news to support it. So what was happening was people were positioning themselves for that news event that was about to happen, and nobody knew about it at the time. I can't tell you in trading how often stuff like that happens, and you just don't know the why until later. And so anyway, were you gonna say something?
I was gonna say, a trade like this too for people, it's always good to go back and look at similar events that unfolded. So this has come out after the fact. India bans wheat exports, but also with everything going on in Russia, I think it was 2010, 2011, they had the Russian wheat fires. So you could go back, look at that and how that played out in the charts, and that might give you an idea of how you want to go long-term kind of trading patterns like this, where you have similar geopolitical events or, a drop in exports.
Yeah, good idea. Well, I mean, even like when a commodity starts going limit up, it usually happens a number of times in a short period. Like back here, it was limit up, limit up, limit up, limit down, limit up, limit up, limit up, limit up, limit up, or maybe not limit up that day, probably limit down that day actually, and then limit up again. So I guess I don't know for sure, but I remember during that move, it was locked in limit up mode for like several days in a row. It was
Yeah.
crazy.
And for anyone watching, what that means is that if you would have been on the short side of that and you were not hedged, you cannot get out of your trade. So you can just get stuck in that trade. And with futures, that is how you lose your house, your home, your car, more than you had in your trading account.
Yeah, you can lose. Yeah, you lose more than you ever invested. That's possible in the futures market, which is why I'm trading this ETF WEAT, not the futures in wheat. So anyway, after a move like that, it is my standard procedure to take some off. So no surprise that see it clips 10%, and that's where I sell my first 10% of my position. So anytime I'm up 10% in a short period of time, I sell 10% of my position, or cover 10% of my position in the case of a short. When the market opened the following day and it failed to go higher or make any type of new high, or really even put in a green candle, I decided to sell 20% more. So I'm 70% still long the position. And my current stop for the rest of the 70% that I still have is this 10-day moving average of closing prices, which today sits at 1154. So I drew it just a penny off. But if we drop down below the 10-day moving average on an intraday basis, I will probably sell another 20% and keep half of my position. And depending on how things look from there, I might even put a 20-day moving average institute for some of my position, but not until the 20-day moving average crosses above my cost basis of 1115. So, I'm pretty much already guaranteed profits. I'm not going to let this trade get away from me. I've got my stop loss at the 10-day moving average for at least half of the position. I've already sold 30% of the position up, a little less than 10%, call it overall. And so if we get a close below the 10-day moving average today, actually, you know what, I actually sold like, I don't know, maybe 5% more of the position today, just because it kind of covered this gap, and I don't want to see it keep going. So I'm looking to get towards 50% of my gains booked, and then stick with either the 10 or 20-day moving average, a close below those as my remaining stop. So this is how you de-risk a trade. This is how you keep your profits, and the trailing stop using the moving average will keep you in the trade if it continues to go higher, but get you out if it drops below. So once you get up in a short period of time, you might as well take some profits off the table, and it gives you the confidence to hold on to that position for the long run, even if it drops a little bit. So
Absolutely.
that's how I'm trading wheat.
Emotionally, it's nice, isn't it? Because now you're swinging profits, or your swing is now paid for. So
Yeah.
you can sit back, relax, let it do its thing, and either you could hit the biggest trade of your life from here, but wherever it goes, no stress, no emotion. That's how you trade well.
Yep. And you can even use, I mean, if like my ultimate stop is my cost basis, I'm not going to let this thing drop below my cost basis. So even if I sold the rest of my position at my cost basis, I still have gains on the first 10, on all these sales I've made up here. So I will not let this trade get away from me. Like, this is a guaranteed win trade for me. So the only question now is, how much money am I going to make? That's it. I'm not going to lose money on this trade. Now, things can gap down. I mean, aside from all that, anything's possible, but it's unlikely that I'm going to lose money on this trade at this point after de-risking it for a gain. So
Yeah.
so that's where I'm at on wheat. yeah, one of the other things I was going to talk about was these knuckleheads. Melvin Capital closing up shop, returning money to investors. Firm lost big on their meme stock. Oh, well, they actually made the firm won big on meme stock surge in the early days of COVID. That's funny. The headline's wrong at Wall Street Journal. So these guys made a ton of money. Actually, you know what? They lost a bunch of money and they had to get backstopped by Citadel. That's right. So they were on the wrong side of a bunch of things. And then Citadel actually invested some money in them, and I think some other big hedge funds kind of did. But ultimately, these guys are done. They're closing up shop. This is what happens when you're long a whole bunch of tech stocks in a market like the one we're in right now, and you don't follow stops. These guys tried everything to keep their doors open, including getting rid of their high watermark for client performance fees. You know, that's what he was trying to do, and the clients got real upset, and this guy withdrew his plan days later and had to apologize to the investors. So this poor guy is only getting what he deserves. I don't feel too bad for him. This is what happens when you don't have a risk management strategy and your whole plan is to go long tech stocks and hold on forever. Like, sometimes your clients don't let you do that. You know, people want to see returns, and if they don't see good returns, they start pulling money out. And when that happens, you get to close up shop. So another hedge fund bites the dust. These guys are not the only ones. There's going to be more. There's going to be a lot more. A lot of people are blowing up these days.
Yeah.
Which is why you see some of the rallies we see, like even in the SPY and in the Nasdaq. Like some of the rallies that you see, like this rally right here, over these few days. This could have easily been a hedge fund blowing up, and from this period, you know, the broker was closing all of the long positions, and in this period, the broker was closing all of the short positions, causing a multi-day rally because it was a majorly big hedge fund or several hedge funds that were all crowded around the same trades. That kind of stuff absolutely happens in the markets, and it's stuff that you have to pay attention to. So you never know. But if I were a broker and I were liquidating a hedge fund, you know what I'd do first? I would sell all the longs as quickly as possible, and then I would cover the shorts after, especially in a declining market.
Yeah.
You know, that's how you do it.
And just a educational thing for people to understand is when you're a hedge fund and you short the wrong thing, why you lose so much, or you could, is liquidity. And if you think about it, penny stocks, that's always a lot of new traders get into penny stocks because they think, oh, look at these big returns. If I buy at $1 and it goes to 2, I'm up 100. If there's no liquidity, you can end up losing a lot more than you think trying to get out and race for the door because nobody wants to take the other side of your trade.
Yeah, I know we've gone on for a little bit. We're almost at 45 minutes, so we'll keep it short here at the end. But just in that vein, I was looking at the old dog money, the people who thought they could buy Dogecoin at a penny and watch it run to $1. This thing is down 80% or so from its highs. Yeah, 82% is what we're down in the old Dogecoin. And then there was the Shiba Inu, the Elon Musk special. I know several people who put $10,000 into this and said, oh, if it only makes it to $1, I'm going to get to retire. And I don't think they understand what this coin making it to $1 actually means. This thing's down 86% from its high of 0.000089 cents, right? So we're talking like 1/10,000th of a cent. To make it to $1, this thing would have to have a bigger market cap than the entire entire global stock market and real estate market combined. It will never make it to $1. It's never going to happen. Not in my lifetime, not in my daughter's lifetime. I don't think it'll ever happen. I think it'll go to zero. It's much closer to zero than it is to $1. So anyway, people are very misguided when it comes to that. And here's the thing: is all these people are the same people who are long the Nasdaq, which is getting absolutely demolished. Nasdaq is now down 26% for the year. It has totally erased all of its 2021 gains, which were obnoxious. If I'm looking for the line to draw here, 12/31, 2020. Right there. So I think it was actually like 313 that it closed at. But so that was all the gain for 2021, and it's now all gone. And we've got, like we said earlier, we've got only 18% lower to go to get back to the pre-COVID highs, which is probably where we belong. So anyway, I think the market's still in a pretty bad spot. Wouldn't be aggressively going long at much of anything. Wheat is my only long holding. I'm short Facebook, short Good RX, and short Macy's as of right now. So still net short, man.
Yeah, not a lot to be bullish about. So, well, I think that about wraps it up, huh, Shane?
Yeah, man, I could do this all day. But yeah, we should let people get back to what's most important, which is family and um, yeah, I don't they can probably stop talking or listening to us knuckleheads discuss what's going on in the markets. Not much to talk about on the long side.
Yep. So awesome. Well, enjoy the rest of your day and see everybody next week on Thursday again.
Thanks, Kyle. Take care, buddy.
Yeah, you too. Bye.